What's up, everybody? Welcome to another podcast. And today, I got a couple of things I want to mention as far as the things that you're hearing in the news to see if it's actually worth it or actually going to be helpful. There's a 50-year mortgage talk. There's also what's called a portable mortgage talk. So let's first talk about your 50-year mortgage. So what I'm thinking as far as having this 50-year mortgage is it might help at the beginning of the process where you're trying to get the qualification for somebody that can't afford in a certain area that they actually want to get into without having to bring in a big down payment. So in my opinion, the only thing that's going to really work is if HUD is actually on board, because if they're not on board, then we're not going to really see a benefit, because if it's just private investors, they're not going to want to do a loan with somebody coming in with little to no money down. They're going to want a bigger down payment to stretch that 50-year mortgage. And if you think about it, these guys are going to make a ton of money on the interest because you're not really paying too much of your principal at the beginning. So what I have here is I'm actually going to show you a quick scenario here on a $500,000 purchase. And if you look at some of these charts, the first one says the 30-year mortgage compared to the 50-year. Yes, you're saving $360 or $370 a month. That would be equivalent to somebody that's buying a house about $60,000 higher. That means that if you're doing a 50-year mortgage, you actually can qualify for about $60,000 additional from the original 30-year portion. So instead of a $500,000 house, now you can get yourself into a $560,000. But if we look at what it really does is, if you look at this next chart, over the next 30 years, if you kept both loans intact without refinancing, obviously your 30-year mortgage, you've already paid it off completely. But if you look at the 50-year mortgage, not only have you not paid it off, but you're still going to have $355,000 left in your principal. So in those 30 years that you've had your home, mind you, this is just hypothetically saying that you did not refinance, you're still going to owe $355,000 on your mortgage. When you originally started, maybe like at $490,000, $485,000. So you really didn't pay off much in those 30 years. You already paid off your $500,000 30-year mortgage. Now if your 50-year mortgage, you still have an additional 20 years to pay that sucker off. So in the first 30 years of life, in total interest, you're going to be paying pretty much 80% of the interest in the first 30 years on a 50-year mortgage. So in my opinion, if you're just looking at it as an option to get into the house, works great because it gets you into the house. And then in the next year or so, maybe 3 years tops, rates do come down a little more and you're able to refinance yourself into a 30-year at a lower interest rate, which would ideally keep the same mortgage payment as if you had that 50-year, but with the 30-year now amortized payment, then it makes sense. If you're also looking at this as saying, hey, look, homes are going to keep appreciating. I just want to get in there, get a decent payment, something I can afford. I'm only keeping the house for X number of years. Equity is going to keep going up. Even if my balance doesn't go down as much, at least I'm not paying my landlord any more rent. And that's another way you can also look at it. It's kind of like doing, a 40-year, 10-year interest only, the way that they have some of these lenders do it now. But again, those lenders that are doing these mortgages are private lenders. The rates are like in the 8s sometimes, and they only make sense when it's short-term and then you're willing to unload on the property. So that's more of an investor situation than it is somebody that's a homeowner. So this is a cool little chart you can look at. Over the next 30 years, it shows you that your net worth, if homes keep going the way they are, it's going to be well over $1 million, but you won't have any mortgage on your 30-year. And on your 50-year, again, you're still going to have an additional 20 years of that mortgage. So I don't know, in my opinion, I'm kind of with having mixed feelings about it, because again, that means I can qualify somebody for a higher price on the property or give them an initial lower payment, but it's not going to help them on the long run. So if you take my advice, which is always have in mind that you're going to be refinancing and shortening up the term, it would work out great. Let me know what your thoughts are, guys. Let me know how I can help.